Donald Trump not only wants high tariffs, but also high stock prices. This is why he's waging a war on the Federal Reserve. But does it really matter who's going to be the next Fed chair? Can Trump have the cake and eat it too? What should you be doing with your money right now? Trump's trade war is so far going his way. Most of America's trading partners have accepted higher tariffs on their exports to the US without demanding reciprocal treatment on the US goods that they import. However long this asymmetry lasts, Trump has demonstrated in just 3 months the extraordinary leverage the United States wields as the world's largest importer. Where previous presidents exercised restraint, Trump has shown readiness to exploit that leverage to the hilt. With the average effective US tariff rate now at 20%, its highest level since the Great Depression, the relative price of US produced goods versus imports is undergoing a seismic shift. This should give a big boost to the import competing sectors. It is still early days, but the US trade deficit narrowed to just 2.4% of GDP in the second quarter, the lowest level since the pandemic. Meanwhile, tariff revenues are surging. In June, the US Treasury reported a $27 billion budget surplus, compared to a $71 billion deficit a year earlier. Trump's trade policy will bring down America's twin deficits. It will also help revive domestic manufacturing. US and foreign companies have already committed trillions of dollars to expand production inside the US, aiming to localize what they sell in the US. Apple alone has announced plans to invest $600 billion in the US over the next 4 years. All else being equal, the US economy should be booming in 2026. As I argued in a previous video, fiscal support from Trump's Big Beautiful Bill will help mitigate the real income squeeze from higher prices on imported goods. Retroactive tax cuts on tips, overtime pay, and Social Security benefits will put more money into the bank accounts of many lower income earners and senior citizens. There is no cocktail more powerful than the combination of higher tariffs and fiscal easing. The outlook for the US economy is strong. There's a lot to like, but there is one little problem. Or maybe not so little. Globalization has become a dirty word. These days, it is the scapegoat for everything that's gone wrong in the world, from wage stagnation and supply chain fragility to the rise of populist nationalism. But it wasn't always this way. Not long ago, globalization was hailed as a powerful driver of prosperity, especially on Wall Street. Why? Because globalization was responsible for the greatest asset price boom the world has ever seen. At the heart of this boom was one simple fact. Globalization put a lid on the prices of tradable goods. Shockingly, prices of tradable goods like electronics and furniture are lower today than they were in 1980, down by roughly 5%. In contrast, prices of non-tradable goods like services have surged by over 400% in the same period. Globalization reduced the wage bargaining power of workers in the tradable sector. Studies show that this also dampened wage growth in the non-tradable sector through spillover effects in the broader labor market. The result was a decline in inflation, of course. Central banks like to take credit for winning the war on inflation. The reality is that globalization made their job a lot easier. Globalization allowed them to bring down real interest rates and keep them low without having to worry about the inflationary consequences of their actions. And declining and low real interest rates drove up asset prices like never before. Globalization might have slowed down wage growth, but it also quickened wealth creation. As a result, US household net worth is now more than $160 trillion, 5 times higher than annual GDP. And here lies my problem with Trump's war against globalization. In theory, the more successful he is, the higher will real interest rates have to reset in equilibrium. The higher real interest rates go, the more overvalued will be current asset prices. Trump wants higher tariffs, but he also wants high stock prices. This is why he's pressuring the Federal Reserve to cut interest rates. But Trump is wrong in thinking the problem is the Fed. His problem is that he cannot have the cake and eat it too. Trump may be counting on AI to offset the inflationary pressures unleashed by his trade war. But so far, there's little evidence of a meaningful productivity boost from AI outside the software industry. And I'm doubtful that ChatGPT 5.0 will change that. The odds of a Federal Reserve interest rate cut in September have increased since the weaker than expected July employment report came out. The market is now pricing a 90% chance of a 25 basis point cut. The new consensus that the Fed will soon ride to the rescue is probably why the equity sell-off on the payroll release reversed course quickly. Some say the US stock market isn't just a reflection of the economy, it is the economy. I agree. Globalization has resulted in a wealth-based economy that relies on asset price inflation as the primary driver of aggregate demand. This is probably why all that people in the market want to talk about lately is who will be the next Fed chair. Since the Fed chair holds only one vote like the other 11 FOMC members, the economics of the Trump economy will ultimately matter more than whether the chair is a dove or a hawk. I don't think the July labor market data are as decisive for the outlook for US monetary policy as many on Wall Street seem to think they are. To me, the most important takeaway from the July job report is that the downward revisions of the May and June employment estimates have brought them closer in line with the initial jobless claims that had surged in June. Non-farm payrolls and jobless claims are not always highly correlated. However, since the start of 2024, the two series have had a high negative correlation of 50%. The fact that weekly initial claims have fallen back below 230,000 is consistent with the hypothesis that as the uncertainty around Trump's trade war eases, companies have gone back to hiring again. I tend to also agree with Jerome Powell that it is too early to know to what extent the slowdown in employment growth is due to the drop in illegal immigration and increase in deportation. It makes a very big difference whether the slowdown in hiring compared to last year is the result of a negative supply shock or of a negative demand shock. Why? Because they call for very different monetary policy responses. The fact that wage growth remains elevated and that the unemployment rate has budged little is consistent with the negative supply shock hypothesis that says the Fed should sit pat. If it is not clear that labor market conditions are softening, it is very clear that inflation is picking up. The latest S&P Global PMI shows that the US leads global PMI selling price inflation to a 26-month high in July. I think the Fed understands that if they're going to make a mistake, they should err on the side of caution. As inflation picks up, the last thing the Fed will want to risk is allowing inflation expectations to go up too. The pandemic shows that even a temporary disruption of global trade can have serious inflationary consequences. What Trump is doing to curtail global trade will be difficult to reverse even after his term ends. My money is on the Fed not repeating its mistakes in 2021. This is why my bias is for higher rates, a higher dollar, and lower stock prices. Thank you for listening.